In this video, traders are going to look at why is the spread usually higher on things like stocks rather than FX when we're spread betting or trading CFDs. Stay tuned. Hey guys, a very warm welcome to you. Thank you for joining me. All right, so this is a question that I've had is why do we have to pay more to trade stocks or shares via a spread bet or a CFD than we do Forex? Now you'd think that if you're trading that's a very active share, let's say you're trading Vodafone in the UK or you're trading Apple in the US or you're trading one of the big stocks that's really popular with traders, you would think that it would be quite cheap to trade. But actually, although it is, and based on history, historic prices are super cheap to trade, it's not as cheap as something like Forex. Because if you look at Forex, you're looking at like 0.6 points, maybe 1 point, 0.8, something like that, maybe even less, depending on who you're trading with. And that's a trade something like Euro, US dollar, GBP, USD, USD, JPY, these kind of things. Maybe not GBP, USD for that kind of thing, but you get the point. The range is quite low. However, when you're trading a stock, like Apple, for example, you might end up paying 15 cents spread. Now, it does depend on the size. It does depend on the price of the instrument, of course. If you've got a really high-priced instrument, you're going to get a wider spread. A lower-priced instrument, a lower spread. But even if you take it into account, you just look at it from a percentage perspective, it's still much wider when you're trading stocks. And the reason this is, guys, is the first thing, of course, is that when you look at the underlying market that these CFDs or spread bets are tracking, the underlying market for Forex is the interbank rate, and we're talking trillions of dollars and pounds trading hands all the time, and the spreads are wafer thin. They are so thin it's almost meaningless. And so that's the cost to the broker, so to speak. If they were going to go out there and hedge everything directly in the market, that's their cost. So they add their margin on to be able to provide the technology and the clearing to us. And so, of course, their margin, a little bit of margin there can still mean that they're making a lot of money. 0.6, they're probably paying, I don't even know what they're paying, 0.0 something, for example. And if you think about it from the perspective of trading a stock, you've got to go and trade with the exchange. Much less liquidity, spreads a little bit wider. But that's not the main thing, because spread betting CFDs, often they'll run a book and they'll end up offsetting one trader against another. The main thing, guys, is purely the order flow. If you think about how the spread betting and CFD companies, firms make money, they go, right, we've got all these people going long FTSE 100, all these people going short FTSE 100. It's about within our risk tolerance in terms of what's the aggregate position. We're making 1 point or whatever it is, either side, 2 points, whatever the spread may be, time of day, etc. That's our money, plus we're making money from overnight positions being held, etc., etc., etc. Now, if you think of when they're trading, when people are trading a currency compared to a stock, how many people are trading a specific stock? Probably not that many. So the cost to them goes up because A, they don't really often have someone to offset that risk. So someone's long Vodafone, someone's not necessarily short Vodafone, or if they are, maybe they're not in the quantities. They're much more likely to have quantities that are far outweighing each other, as opposed to when you look at something like Euro US dollar and you say, well, there's going to be hundreds, if not thousands of traders trading that, probably going to be relatively even. And even if it's not, the fact that you can triangulate the currencies around, so long Euro US dollar, then you might have US dollar GBP, you might have GBP Euro. So you've got all the three currencies all trade against each other. They can pair off and neutralize their exposure based on the net book. So it's far easier for them to do that. So the cost to them is better because they haven't got the exposure that they have to, wouldn't have to have the hedging costs, etc., etc. Whereas you look at an individual stock, yes, theoretically, if you had the FTSE 100, you could offset that against a FTSE 100 futures contract or a cash spread bet. But when you're picking out individual shares, that's why it's a little bit more costly, because there's a little bit more process involved. They've got to hedge a little bit sooner than they would normally because they can get caught out. If a big trader comes in or have a lot of traders coming in all of a sudden buying Vodafone, for example. Now, yes, potentially you could probably hedge off against a FTSE 100 because they're waiting on it, but any other stock, let's say they've got big buying, they're going to have to offset some of that. Yes, they might hold some risk, but they can't do it over every single share. And so there's a cost to them to go out and hedge this because they haven't got the two-way order flow. Whereas if you're trading Forex, very popular, lots of two-way order flow, the ability to arb themselves off, if you like, against all the products that they're offering. And so it becomes much cheaper because all they're doing then is literally taking the margin between all the guys who are long US dollar in some way, all the guys who are long euro, all the guys who are short euro, all the guys who are short USD, aggregating it all off. Everyone's got their positions and they're just taking the chunk in the middle. So that can be much narrower and much cheaper than each of these hundreds of individual stocks potentially going out. It's the same as well, guys, for if you're looking for the soft commodities. You know, soft commodities like wheat, corn, cocoa, etc. Yes, many of the spread betting firms do offer it, and the spreads are wider purely because they don't have the flow to be able to offer the narrow spreads. You know, it's a little bit more work for them. You might be one of only a handful of people trading it. So yes, they offer it, but it's a little bit more expensive. That's really, guys, why if you're trading Forex, you get those tight wafer-thin spreads. And why if you're trading more popular markets as well, you know, like FTSE's tight spread, DAX tight spread, Dow tight spread, you start to go into the indices that maybe aren't as commonly traded, like the Russell or FTSE 250, for example, then they're wider. Of course, the underlying as well, they've got to take into account, like we said at the beginning of the video, but it's really to do with the amount of flow they've got coming. They've got two-way flow, narrow spreads. If they don't, you have to widen it a bit to pay for their costs. All right, guys, take care, keep your risk management, whatever you're doing. Bye-bye.